Hey everyone, you've probably heard of candlestick patterns, but have you encountered harmonic patterns? Well, you're in the right place because we'll break it all down for you. We'll dive into harmonic patterns, how they work, and most importantly, how you can use them to enhance your trading results. Let's go! So what are harmonic patterns? They're a special set of patterns based on Fibonacci ratios. Essentially, these patterns deliver results more often because of their mathematical foundation. You can spot them across any financial market, but today we're focusing on crypto. Harmonic patterns combine both graphical and mathematical elements. Experts consider them some of the most accurate tools in technical analysis, helping us predict price movements and the likelihood of specific market events. Now let's walk through the key harmonic patterns you need to know. First up is the butterfly pattern, which helps identify potential reversal points at the end of trends. Pay close attention to the completion points of the patterns, as it often serves as a key level for initiating trades. Next, we have the bat pattern, which is also great for spotting potential reversals, but typically on shorter time frames. The most common pattern is the Gartley pattern, which forms during corrections and is known for its reliability. We recommend starting with this one, as it's often used to pinpoint the best entry and exit points. Each of these patterns has a specific structure and strict construction rules, making them reasonably reliable. You'll notice that all harmonic patterns share a similar structure due to their precise proportions. Most of these models include 4 price swings marked by points X, A, B, C, and D. To draw the pattern on a chart, you'll typically start by identifying a double top or double bottom. These are the key points to look out for. Here is a breakdown of the structure. X, the level where the pattern begins. A, the following price peak. B, a pullback from X and A. C, a retracement of A and B. D, the final point and your trigger for entering a trade. By the way, if you want to explore Fibonacci levels more deeply, check out our other video in which we cover this topic in detail. Now that we've got a solid understanding of harmonic patterns, let's explore how they're applied in real-world trading. Here's a simple example. On the Bitcoin USDT chart, we can see a butterfly pattern forming. The price is approaching a key Fibonacci retracement level, signaling a potential reversal. Using this as a signal, you can enter a trade with minimal risk. And to illustrate this, let's plot out the butterfly pattern. Typically, traders use an XABCD template, starting by placing points A and C at local lows. To increase the pattern's effectiveness, point B should be at the 0.618 Fibonacci retracement level, while point D should be slightly higher at 0.786. Point C also aligns with this retracement level, but you'll need to stretch the Fibonacci grid from point A to point B. This creates the harmonious figure we're aiming for. Of course, like any tool, harmonic patterns don't offer a 100% guarantee. Their most significant advantage is that they clearly identify entry and exit levels. Still, a downside is that they work best in trading markets and can give false signals during periods of high volatility. So, to sum it up, harmonic patterns are a powerful tool for experienced traders, allowing you to pinpoint key market reversal points. The key is to stick to the correct proportions and combine them with other indicators for the best results. If you found this video helpful, please like it, share it with your friends, and subscribe to the Doc Master channel.